Earnings season has begun, and there's a lot to discuss. A 21% ROTCE for JPMorgan is the best in the biz. Right now, Nvidia is worth $1 trillion more than Apple. Pretty amazing. Both indices are at all-time highs, with the S&P up over 7% and NASDAQ up over 8%. It's been quite a wild ride this year. The only thing that can derail this story, in my view, but before I get to that, I have something very personal to say. Hi, this is Steve Eisman, and welcome to another edition of the Weekly Wrap. This weekly wrap will be longer than usual because earnings season has begun, and there's a lot to discuss. But before I get to that, I have something very personal to say. About a month ago, I was diagnosed with breast cancer. That's right, breast cancer. It's been caught early, and my doctors believe very strongly that I will be totally cured. But the treatment will take several months. I'm making this announcement for two reasons. First, I will be podcasting during the treatment, but because I will be receiving chemotherapy, I may at times look tired, and I might lose some of my hair. Rather than have people speculating about why my appearance has changed, I decided to make this public. More importantly, I'm doing this to make men aware that breast cancer does not occur solely in women. Yes, breast cancer in men is somewhat rare, but it does happen. I had a skin irritation on my left breast for a few months, which I ignored. A month ago, I was playing squash, and my squash partner, who thankfully is an oncologist, noticed it in the locker room. He examined me there and sent me to get a mammogram immediately. Probably saved my life. So thank you, Dr. Rob Gelfand. My point is that but for my good friend, I would never have given my skin symptoms a second thought. So my message to the men out there is that if you notice something strange on your breast, have it checked out. And now for the weekly wrap. First, the stats. For the week ended July 18th, the S&P 500 was up 60 basis points, and NASDAQ was up a very impressive 1.5%. For the year, both indices are at all-time highs, with the S&P up over 7% and NASDAQ up over 8%. It's been quite a wild ride this year. The week began actually on Sunday with more tariff news. President Trump announced 30% tariffs on Mexico and the EU if deals are not reached by August 1st. On the other hand, on Tuesday, the U.S. government will reportedly approve licenses for Nvidia to resume sales of its H2O chip to China, months after effectively banning them. The H2O chip is not Nvidia's top chip, but this move suggests a pivot away from a strategy of broad technology bans on China and more towards more selective bans. Nvidia rose on the news and is now at an all-time high of $4.2 trillion. The top 5 stocks in the S&P are now and in order: Nvidia, Microsoft, Apple, Amazon, and Meta. Right now, Nvidia is worth $1 trillion more than Apple. Pretty amazing. All right, so this was the beginning of earnings season. Let me just say a few words about how I look at earnings season. One thing I don't do is try to predict how stocks will react to earnings. Trying to predict that is incredibly complicated. You need to ascertain what expectations are, and more importantly, how short-term investors are positioned. A company could report great numbers, but not beat the whisper numbers, and the stock goes down that day even though the fundamentals are excellent. For me, I don't short-term trade, so I'm not involved in that game, but others are. I use earnings season as a check on what I'm thinking about a particular company and about the general economy. It's a thesis check. I have a thesis on a stock and on the economy, and earnings season is an important data point for me to see if my thesis is correct. So earnings season started on Tuesday. Tuesday and Wednesday were big days for bank earnings. But before we even get to that, let me define two crucial terms that people who focus on banks look at, and they are return on tangible common equity, or ROTCE, and price to tangible book value. Now, ROTCE, or return on tangible common equity, is you take net income and you divide it by tangible common equity. And tangible common equity is common equity less intangibles. This is the key measure of bank profitability that bank investors care about. Price to tangible book value is the stock price divided by tangible book value per share. And this is the key measure of bank valuation. These two metrics are key in understanding banks. Essentially, a bank with a high ROTCE will have a higher price to tangible book value valuation relative to other banks. I'll have a lot more to say about this in a future financial literacy lecture. First up, JPMorgan Chase reported core EPS for the second quarter of $4.96 a share on revenues of $45 billion, up 6% year over year. That's the revenue. These results generated a 21% return on tangible common equity. A 21% ROTCE for JPMorgan is the best in the biz. No one is higher. The quarter was also characterized by strong capital markets revenues, with beats in both trading and investment banking. This was a beat and raise quarter. All in all, very strong results from JPMorgan. Second up, Wells Fargo. Not as good. Wells Fargo has had a problem for years. Because of the 2017-2018 scandals, the Fed penalized Wells Fargo with an asset cap, meaning it could not grow its balance sheet at all, even by a single dollar. This has meant that Wells has grown earnings slower than it otherwise would have without the cap. Now, about a month ago, the Fed announced that it was finally removing the cap, but the transition period was always going to show uneven results, and this quarter proves that. Wells Fargo reported second quarter earnings of $1.54 a share on revenue of $21 billion. Revenue was up less than 1% year over year. Now, these results generated a 15.2% ROTCE, pretty good, but not nearly as good as the 21% of JPMorgan. The bottom line is that Wells Fargo missed on net interest income because of the asset cap, met on fee income, fed by strong trading, card revenue, and other fees, but beat on earnings per share due to lower than expected loan loss provisions. This is the fourth quarter in a row that Wells Fargo has released loan loss reserves. Wells Fargo guided fiscal year 25 net interest income to be roughly in line with last year, whereas before it had guided to be up 1 to 3%. This is the second time in recent times that Wells Fargo has lowered its 2025 net interest income outlook. I would just point out that when comparing JPMorgan to Wells, that JPMorgan raised net interest income guidance and Wells lowered theirs. The asset cap hurts. Yes, it does. Citigroup also reported on the same day, reported second quarter earnings of $210 on revenue of $21.7 billion. The revenue was up almost 10%. Now, this generated a return on tangible common equity of 8.7%, the lowest of any large bank in the United States, which is why Citi, alone amongst the large banks, trades below tangible book value. EPS and revenue beat street expectations, and more importantly, all 5 of Citi's key businesses lines showed year-over-year revenue growth with 3 in the high teens. This is clearly a beat and raise quarter. Jane Fraser is clearly doing a very good job and is the best CEO, in my opinion, Citi has had in decades. But I just point out a few caveats. With a still subpar 8.7% return on tangible common equity, Citi is still worse in class amongst the large banks. It is the only large bank with a ROTCE below 10%. Remember, JPMorgan is at 21%, Wells is at 15%, and that again is why alone amongst the large banks, Citi is still valued slightly below tangible book value. One more thing. At $90 plus, Citi is now back to the highest price since 2008. Now that sounds great, but pull up a chart showing Citi's stock price from before the financial crisis. The stock's all-time high was $557, which occurred at the end of 2006. The great financial crisis created massive shareholder dilution. Yes, Jane Fraser is doing a good job, and yes, the stock is doing well, but we will never see $557 again. BlackRock, the largest asset manager in the world, also reported on the same day. The company had a mixed quarter. Company beat on earnings because of much higher investment income, which analysts always discount. The big complaint was that total net inflows were $68 billion, which was below the estimate of $85 billion. BlackRock had one massive outflow over $50 billion from one institutional client in an undisclosed low-fee index product. Long-term inflows were $46 billion for the quarter, which was also below estimates. Pretty amazing that an asset manager can have $46 billion in long-term inflows and have that be a disappointment. And that was Tuesday. Wednesday, Goldman Sachs. Core earnings per share of $10.91 versus $8.62, up 27% year over year, and beat the estimate of $9.59. It was a beat in both trading and investment banking. Trading, like other firms, was particularly strong as a result of all the volatility. Financial advisory came in at $1.2 billion, up 71% versus last year, a good sign that M&A is finally picking up. My one caveat about Goldman Sachs is that its return on tangible common equity is still not great. It's getting better and came in at 13.6%, but that is still below most of its peers. Only Citi is consistently lower. Goldman Sachs needs a more robust M&A and IPO environment, which is what the market is hoping for. Morgan Stanley also reported on Wednesday, reported core earnings per share of $2.13 versus $1.82 last year, up 17%, and beat the estimate of $1.98. Results were somewhat similar to Goldman Sachs in that investment banking and trading were good, but the Morgan Stanley results were not as much above estimates as was Goldman Sachs. But Morgan Stanley's return on tangible common equity was 18.2%, which is second best in class. The only big bank that is better is JPMorgan. And the reason why Morgan Stanley's return on tangible common equity is so high is largely due to its large asset management and brokerage divisions. M&T Bank, a very good, solid regional bank, reported core earnings per share of $4.12 versus $3.75 last year, up 9.9%, and versus the estimate of $3.97. Good overall quarter from M&T, which is what the market always expects, and the return on tangible common equity was 15.5%, which is equivalent to Wells Fargo. PNC Bank, one of the largest regional banks, reported core earnings per share of $3.85 versus $3.30 last year, up a nice 17%. A strong net interest margin fueled the beat, and PNC's return on tangible common equity is 15.6%. Quite good. Bank of America, somewhat disappointing. Core earnings per share of 89 cents versus 83 cents, up 7%, and versus consensus of 86, so a small beat. Now, while Bank of America had good results in trading, total revenue missed by a little bit. Bank of America is the only bank that has reported so far to report a total revenue miss this quarter. Now, Wells Fargo, as I discussed before, missed on net interest revenue, but not on total revenue. So why, you ask, did Bank of America miss on revenue? Because when rates were zero, Bank of America made a bad bet and bought a ton of long-term bonds, somewhat similar to Silicon Valley. And those bonds are underwater and weigh on Bank of America's net interest margin and will continue to do so. That is why Bank of America's return on tangible common equity was only 13.4% this quarter, which is slightly below Goldman Sachs's 13.6% this quarter. I'm putting up a table on the screen to help you see the relationship between return on tangible common equity and price to tangible book value valuations. I'm using the stock prices as of the close on Wednesday. This table, I think, is pretty illuminating. JPMorgan and Morgan Stanley have the highest return on tangible common equities and are both at around 3 times tangible book value. Now, Morgan Stanley has a lower return on tangible common equity than JPMorgan, but a slightly higher price to tangible book value valuation. Why? To be perfectly honest, I'm not really sure. It might be because Morgan Stanley has a higher percentage of its earnings coming from wealth management than JPMorgan, and people like that better. But frankly, over time, the two banks switched back and forth on who was valued higher. Wells Fargo M&T and PNC all have return on tangible common equities of 15% and are all valued similarly. Now, Bank of America is valued similarly to them, even though its return on tangible common equity is lower. But investors think the net interest margin problem will eventually go away. Goldman Sachs is a bit of an anomaly. It has a return on tangible common equity below 14%, but is valued higher than those banks with 15% return on tangible common equity. That's probably because investors think that M&A and IPOs will pick up, and Goldman Sachs is the purest big bank way to play it. And finally, while Citi is improving, it is the only large bank with return on tangible common equity below 10%, and that is why, despite its strong performance this year, and the stock is up 28% this year, it's still valued slightly below tangible book value. Switching gears, Progressive Insurance reported also on Wednesday. This is probably the best property and casualty insurance company maybe on planet Earth. It's still mostly auto insurance with homeowners as well. Progressive reported $4.88 versus $2.48 and beat the estimate of $4.29. Net premiums earned were up 18%. Quite strong for a company this size. Johnson & Johnson beat quarterly sales expectations and raised its full-year outlook, showing confidence as the pharmaceutical industry faces threats of tariffs and a crackdown on drug pricing. The company said that a slow ramp-up to tariffs would be better news for it, as it would show an understanding by the government that pharmaceutical manufacturing facilities cannot be created overnight in the United States. And that gets us to Thursday. GE reported. Before discussing GE's quarterly results, let's first ask, which GE are we talking about? In the 1990s, GE was an iconic conglomerate company run by Jack Welch. But starting in late 2001, Jeff Immelt took over and then began a slow and inexorable decline. In 2018, GE brought in the first outsider to be CEO in over 100 years. Larry Culp, who they brought in, had been the CEO of Danaher. At first, he tried to fix the entire company, but eventually realized that the best thing to do was to break it up. So now there are 3 GEs, and they're all separate companies. There's GE Aviation, whose symbol is GE, and they manufacture aircraft engines and parts. There's GE Vernova, symbol is GEV, which mostly manufactures gas turbines for utilities, but does some other related things as well. And then there's GE Healthcare, GEHC, a medical technology company. GE and GEV stocks have done incredibly well since their spinout, but GEHC, the healthcare company, has languished. On Thursday, GE Aviation reported this GE is riding a wave of an increased need for new commercial aircraft because of increased air travel. Results were quite good. Adjusted EPS of $1.66 versus $1.20, which is 38% growth, and versus the estimate of $1.43, an impressive beat. Adjusted revenue of $10.15 billion was up 23%, also impressive, and beat the estimate of $9.59 billion. The company also raised guidance. Turning to healthcare, Elevance, ELV is a symbol, a large health insurance company. There has been a very negative trend in health insurance companies for a while now. Medical costs keep going up, and the higher the medical costs, the less a health insurer makes. While revenue of $49.4 billion beat the estimate, adjusted earnings per share of $8.84 missed the consensus of $9.20 and was also down from last year's $10.12. The company lowered its fiscal 2025 guidance from $34.50 per share to $30. Quite a cut. And the stock got roasted on Thursday and is back down to levels not seen since, get this, February 2021. In non-earning news, but I thought quite important, Archer Daniels Midland, a food processing company, declined by about 1% on Thursday. ADM supplies high fructose corn syrup, which is an ingredient in Coca-Cola in the United States. President Trump announced that Coca-Cola in the U.S. will start to be made with cane sugar. Now, I've had Coke outside the U.S. where it is made with cane sugar, and frankly, It tastes better. So I think this is good news. And the last company to discuss its earnings are Netflix. Netflix reported after the close on Thursday and reported earnings per share of $7.19 versus $4.08. That's 47% earnings per share growth, and beating the estimate of $7.08 by a bit. It raised guidance for the year, but the stock was down on Friday. Why? Well, the stock is up 40% so far this year, and I'm guessing that the whispered numbers out there were higher. Let me add that what Netflix has achieved in the last 10 years is extraordinary. Its market cap is $515 billion. Its once big competitor, Warner Brothers, has a market cap of only $32 billion. And its next biggest competitor is Disney, which has a market cap of $218 billion. In other news, there was a report that Union Pacific, the railroad company, is contemplating making a bid for its railroad rival, Norfolk Southern. Now, if the advisors of UNP think such a deal could go through, then we could be on the cusp of an M&A wave the likes we have not seen in a long time. So bottom line about earnings season, it's early, but so far the U.S. economy looks fine, bank results were good, credit quality was benign, and the consumer continues to spend. The only thing that can derail this story, in my view, is a trade war. And now the mailbag. The first question is from Enrique, who gives me a nice thank you for my podcasts, and then asks the following question. Your focus is 100% the US. Why is that? Curious to know if it is an active or a passive decision. My answer to his question, which I think is an excellent one, I do look at overseas markets, but for informational purposes only and not to invest. I only invest in the US for a very particular reason. I believe strongly that tech is where most of the action has been and will continue to be over the next several years. In the United States, the infotech sector represents 31% of the S&P 500. But if you add in tech and tech-related companies that are not in the infotech sector, like Meta, Google, Amazon, and many others, you get to at least 50%. There is no other country in the world with anything close to that percentage. And that's why I like to invest only in the US. And the second question is from Banana Lake Fishing 6077. Can you give a 1-minute explanation why you are long only now? This may take a little bit longer than a minute, but I'll try and keep it short. First, I'm not completely long only. Once in a while I short a stock, but not often. So here goes as to why I'm mostly long only. Back in 2007, I was very negative. I thought that the financial system was at risk, so back then I was incredibly bearish. For 2 years, I ran my hedge funds net short, meaning the size of my longs were smaller than my shorts, often by quite a lot. In the hedge fund world, that is very unusual, but I was right. Now, post-Great Financial Crisis, 2 things happened to make me alter my view. First, Daniel Tarullo was made the vice chair of financial supervision at the Fed, which is a fancy term for chief bank regulator. And Tarullo did a great job. From 2011 through April 2016, the period of his tenure, he forced the banks to massively delever and de-risk. And when he was done, I felt strongly and feel to this day that our banking system is safe. And yes, I know people worry about the tremendous credit growth in private credit, but there is so little credit data available that it's hard to come to any firm conclusions. Although I do believe that private credit will not cause a recession. What I do think is that when one day we do have a recession, the weaknesses in private credit, wherever they are, will be exposed. The second thing that happened was that in 2014, I stopped managing hedge funds and joined Neuberger Berman. Now, prior to Neuberger, my principal areas of focus had always been the financial services sector. My knowledge outside of financials was limited, so I spent the next bunch of years researching the other sectors of the S&P with a particular emphasis on technology and industrials. That education began to change my view about the U.S. economy. I developed a real appreciation of how dynamic the U.S. economy was becoming. And with the advent of AI and the resulting CapEx that is taking place around this innovation, I strongly believe that the U.S. economy is more dynamic today than at any time in my lifetime. So long term, I am quite positive on the U.S. economy and the stock market. And that's the wrap. I want to emphasize that I read all the comments, and I really enjoy answering some of them on the Weekly Wrap. If you want to make a comment, you can do so on YouTube, or just email it to me at info@steveeisman.com. The podcast will be dropping next week, are interviews with two short specialists. In both interviews, I try to get at what makes a good short, what makes a bad short, and what risks are created by shorting stocks that generally don't exist with longs. Hope you will tune in. So thanks for listening, and please subscribe to our YouTube channel on YouTube because it really helps us out, and we'll see you next time on the Weekly Wrap. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.